Hey guys, how's it going? My name is Colin Jones and welcome back to the channel. In this video, I'm going to be covering the top 3 most common mistakes people make with the 3-step model. As always, make sure to like and subscribe, and let's get straight into the video. So first and foremost, probably one of the biggest issues I see with people trading the 3-step model is that they're not trading with a daily bias. And the problem with not having a daily bias is that I don't want to call it gambling, but the whole point of the 3-step model is to base it off of fair value. Well, that's fine, but pretty much every morning we'll have fair value above and below us, unless we're at all-time highs. So without a bias, it's hard to tell which one you're going to be searching for to take a trade, which then affects win rate, consistency, all that good stuff. I personally never trade without a daily bias. Personally, for me, daily bias is super easy because I have this sweet OHLC stat map indicator by 2 degrees. And this indicator essentially just automates my daily bias. Now, the way it works is it takes the maximum look back data you have on your trading view plan, and it takes into account time and price in order to automatically draw out these manipulation and distribution levels on your chart. This makes things quite easy for me because I can just look for a manipulation or distribution level to get hit in order for me to decide my bias. If one of the bearish manipulation levels or distribution levels gets hit first, then I'm bearish for the day. And if it hits a bullish level first, I'm bullish. It may sound kind of silly to use an indicator for bias, but to be honest, it's all based on statistics, and I would probably have a slightly smaller win rate without it. If you guys are interested in this indicator, I'll leave the link in the description below. So I'm going to show you an example of what happens when you try to fade your daily bias. So for me, my bias here is bearish. Let's assume that you either didn't have a bias or were bullish on the day, fading the obvious daily bias. Even if you didn't have the stat map on, you can see we inverse a 30-minute gap as soon as market opens. So what does that tell you? We're probably going to be bearish for the day. But if you ignore this and choose to be bullish, watch what happens when you find a 3-step model. This is the day that I was just showing you guys, and let's go ahead and watch this. So we're bullish, market opens, we dip down as you would on any Judah swing, right? We dip down and we tag this 15-minute inversion gap. If you notice here at the lows, we have a lower low and a higher low. On NQ and on ES, we have a higher low and a lower low. So that's your SMT. So you have a high time frame gap, you have your SMT, and you have a breaker here. Your breaker is right here, the up close candle from the low, high, lower low, and higher high. So this is your entry. So as soon as we close above this high here, you're in, right? Stop loss goes below the SMT, and we take a standard deviation to find our targets. So first target will be this high right here at 1 standard deviation. That's not quite 1-to-1, so we'll target 1.5. Let's play this out. Oh, wrecked. Why? Because we had the wrong bias. Our draw on liquidity was incorrect. Now let's look at an example of a correct daily bias. So using the stat map, we have a bearish manipulation level get hit. Therefore, we are bearish, so we should only look for bearish setups. However else you find your bias, like I said earlier, we had the 30-minute inversion gap. You could have used that just as well to get your bias. Looking here at the 90-minute chart, you can see we have a 90-minute SIBI right here, as well as a 90-minute inversion right here. As you can see, we're going to wait for the macro to start at 9:50. We dig up into that 90-minute SIBI once more. It's also inside of the 90-minute inversion gap. When we do so, if we look at ES, you'll notice that ES creates a higher high and a lower high, and at the same time, on NQ, we have a lower high and a higher high. So that is your SMT. So the only thing you need left is a change in the state of delivery, which we have right here when we close below this 1-minute buy side imbalance, creating an inversion gap. There's your low risk sell. Your stop loss goes above the SMT. For your targets, take a standard deviation, and we'll target between 1 and 2. So for me, I'm just going to target 2 at low of day. And as you can see, we do end up taking that. The second most common mistake I see people doing with my 3-step model is actually their stop loss placement. Let's take a look at a chart example here, and I'll show you what I mean. So here we have an obvious bullish bias, right? We have a high time frame breaker, a low, a high, a lower low, and a higher high. This is on the 4-hour chart. And with that, we created a bullish fair value gap. Now, this is also a bullish unicorn setup as well, because we have a breaker with a fair value gap. Down here on the 15-minute, as you can see, we do end up tagging this 4-hour gap. And if you look on the 5-minute here, if we take a look at this candle's low, we did end up sweeping that here on NQ. But if we look at ES at the exact same low, if I just draw that out, you can see that we did not quite come to that. So that's your SMT. So we go back to NQ and we draw that from this low to this low right here. So down here on the 1-minute chart, let's see a candle close above that. You can see we do get a close above consequent encroachment. However, I want to see a close above the fair value gap as a whole. So we get that right here. So that's your entry long. Now, a lot of people would want to have their stop below this low right here, or even this swing low. Now, if this was a 2022 model and we had just swept liquidity and formed this fair value gap afterwards, that would be valid. However, this isn't the 2022 model. This is my 3-step model. Let's watch what happens if we simply try to target this low resistance liquidity up here. As you can see, it's a real nice trend line, low resistance liquidity. Let's play this out. As you can see, we did get stopped out, but let's watch something. We end up flying towards that direction anyway, and lo and behold, we end up taking out that target. Now, you would have gotten stopped out on this move after it took you to your target. So here's how to fix this. Remember earlier I had mentioned we formed SMT on the 5-minute chart down at these lows. That SMT is what confirms the fair value gap. Price should not disrespect that level. If we were to enter here and instead have our stop loss below this SMT and targeting the same level, it would be a pretty bad risk to reward, right? That's where your standard deviations comes in. So we take a standard deviation of this manipulation leg and target 1 standard deviation, right? That's a much better risk to reward. It does take a bit to get there, but you didn't get stopped out on the move. And instead of targeting only 364 ticks, now you caught 756 ticks while not getting stopped out, which is a nice segue into the third most common mistake I see in the 3-step model, which is actually finding your targets. So the way I go about finding my targets is actually pretty simple. I use a Fibonacci retracement tool with the standard deviation settings on it and reverse on. And while a lot of people think that I use the entire leg up into the bearish fair value gap, I actually only use the leg that caused the SMT, which in this case would be here, right? We had SMT between these two highs. Therefore, our highest high is going to be our most recent manipulation leg. So I'm going to take from wick to wick that manipulation leg to find my targets. What I like to do is always target -1 standard deviations. Now, if you'll notice here, -1 standard deviations is actually not quite 2R. Now, I prefer in most of my trades to at least target a 2R. So what I like to do is watch this -1 level if it's not already 2R for a reversal. If we hit that level and we start reversing, I'm out of the trade. However, if we continue through that level, I will look to take profit at 1.5. Now, this is a lot closer to 2R, so I'd be probably pretty happy with this. Now, it's not quite 2R, so if you want, you can target 2 standard deviations. Now, I really don't like to target anything past 2 standard deviations because 2 standard deviations begins the potential reversal zone, which I will mark in gray. If 2R is prior to -1 standard deviation, I will just take profit at 2R. I will use that 2R level to see if we start reversing. If we don't, I will target 1 standard deviation and I'll be all out. However, if 2R doesn't come till 2 standard deviations or even 1.5, I'm totally fine with targeting either of those, just making sure to watch them for potential reversal spots. So let's go ahead and start to play this out. As you can see, we barrel towards all 3 targets in about 1, 2, 3, 4, 5, 6 minutes, and that becomes the trade. So that's how I use standard deviation to find my targets. Don't let anybody mix you up. This is the proper way to do it. Thank you guys so much for watching. I hope you got a lot of value out of this video. If you did, please make sure to like and subscribe. And as always, I live trade this exact 3-step model that I've been teaching you guys in my Discord every single day. So if you want access to that for completely free for 7 days, all you have to do is click the link in the description to start your free trial. Thank you guys for watching, and I'll see you guys next time. Peace.